What's next for retailers and consumers? Mr. Thomas Hayes, founder, chairman, managing member of Great Hill Capital. Good to see you again, Thomas. Last time, I think you helped us make some money. This time, I think the retailers made money on consumers. But let's be honest, people are still spending money. The economy has not slowed down. Things are still hot. What do we got wrong here?
I think you're right. I think you saw the retail sales stronger. Year on year up 8.37%, month on month 1.3 versus 1%. And the retail earnings that we're seeing coming in, Phil, are much better than expected, with the exception of Target, which was the misbehaved child. The rest of them were knocking it out of the park. Walmart picked up some shoppers from people trading down, number one. Number two, they had their inventories in line ahead of time, so they didn't have to do quite as much discounting. And they just did tremendously well. They increased their forecast moving forward. They announced a $20 billion buyback. It was Shangri-La. And then you see on the other side of the ledger, Target absolutely couldn't be any worse. Their operating income was down 50% year on year. They had to sell down a lot of inventory. It was mismanagement from COVID is basically what it comes down to. And they're expecting shrinkage, meaning theft, in their stores of $600 million in 2022. I think they should buy some of their own security cameras.
I saw that. I saw what the heck? Explain to our audience what that means, the shrinkage and the theft.
Shrinkage means, they're calling it organized theft, but basically in many jurisdictions, people are not being prosecuted for small thefts. So it's accelerating at a rapid pace. And it seems like Target has been unable to successfully control it like some of its competitors. And then, we shift. There was also a shift away from it. It's almost like we're in a rich man's recession. White collar people are afraid of losing their jobs because you're seeing Meta, you're seeing Salesforce, you're seeing Microsoft lay off, while blue collar people are actually getting pay raises because there's such a demand. So that's why you're seeing the divergence between the Target, which tends to be higher scale consumers, and Walmart, which tends to be lower scale. They're picking up some of the higher scale now. Moving in that direction. But then Home Depot and Lowe's, with all the home equity and mortgage rates rising, everyone is now remodeling their houses, which on average are 40 years old and on average now have $207,000 of home equity. So rather than sell your house at a 2.5% mortgage you may have and move to a new house with a 7% mortgage, people are staying put and they're investing in their own houses. And the results from both Lowe's and Home Depot were off the charts.
How does the holiday season look to you? Are we being too optimistic or too pessimistic? Because I've heard both sides of it, and we're probably somewhere in the middle, is my guess.
Yeah, I think it'll be decent. The expectations are for 7.5% growth year on year. Net of inflation, that's only 1 to 3% in real terms. Where you're going to see a lot of discounts, Phil, is in the consumer electronics. How many MacBooks and phones can you have? I think people loaded up on the consumer electronics during COVID. So you could see discounts, according to Bain, for computers of 32%, toys 22%, TVs 19%, appliances 18%. Et cetera, et cetera, et cetera. But I think service-related things, things that are not necessarily physical items that we all stocked up on during COVID, are going to do quite well. So there will be a balance: less demand for goods, more demand for service-oriented type of gifts and products and excursions, et cetera. I think will be the theme going forward. But all in all, I think it will be a happy holiday season.
And then if I'm the Federal Reserve and I'm watching this and people are still spending, albeit they're spending on different items, but it doesn't really decrease the inflationary pressures that have been on the economy for the last 6 months. It sounds like to me that they're only going to stop raising rates when people start losing jobs. And I hate to say it that way, but I don't know how else to say it.
Well, it's starting to happen, and I think we're going to get, first off, we did have two very positive prints as it relates to inflation with the CPI and the PPI. And when you look at money supply, how it's collapsed year on year, and how that works on a lag basis, usually when you get that first rollover like we had in this CPI and PPI where it was a big drop, the following drops tend to be more and more precipitous. So the key thing that we want to pay attention to, Phil, is number one is the non-farm payrolls report in the first week of December. And then second, we're going to get another CPI print before the next Fed meeting. If both of those come in, meaning less jobs than expected, unemployment rate ticks up, and the CPI comes in lower, we know, generally speaking, 75 basis points is off the table after the PPI and CPI. If we get further good readings, there's a potential for 25 basis points, but I think the odds-on bet is 50 basis points, which means we're out of the emergency period of 4 consecutive 75 hikes. Now we're down to 50, maybe it's 50, 25, and then we pause for a little while and see the lagged effect and see what happens with jobs.
It's such a strange world we live in. You basically want bad news so that we can have good news, and if we have good news, that's actually bad news. Thomas, always good to see you. We'll talk again very shortly. Appreciate the analysis.